It's a real privilege to be here. Believe it or not, I've been out of the country for 13 years. I've been working in agribusiness and food for pretty much my entire career. This is my first speech I've ever given in Australia. So, look, it is a real privilege to be here. When Adam called me about a month ago, and Adam used to work for me in Rabobank in Singapore, and I have to say he had probably one of the best jobs in our team. He got to travel to the far-flung places to look at analyse various industries, China, Thailand and Indonesia. So Adam came back to Australia with a lot of good experience by in many respects getting his hands dirty. So Adam, thank you very much for the direct invitation, and the Australian Farm Institute. Thank you very much for having me. My topic today is it's about investor appetite and potential solutions for Australian agriculture, and around that sort of long-term perspective. I'm going to talk about how particularly Asian investors perceive Australian agricultural investment. There's some positives and there's some less positive aspects to that. And then we're going to run through the rationale for certain structures that eventually will probably be adopted to a certain extent in our industry. So let me, another disclaimer, sorry. I'm going to start with a quote from Georges Andre. The secret to success in grain business is to sell cheaper than you buy and still make money. That might confound pretty much everybody, and it does me. I'm going to leave that comment with you to ponder until we have the question and answer session. It underscores how sophisticated our world trade markets are, and how something as illogical as that statement is makes sense. Now, just on this, talk about profit. My wife and I, we have a cattle property in Australia, up in the northern tablelands, but we also own a steak restaurant in Singapore. And as you all know, we've been through a rather tough time in Australia in the beef industry. I was fortunate enough to be able to sell some cows in April, just after the dry, but prices really hadn't recovered. And we sold our cows with the calves off and the calves sold separately, but the cows made about $250 a head. If you come to our restaurant in Singapore, I'm very pleased to announce that if you go for the signature steak, the 1.2 kilo Wagyu Holstein T-bone or ribeye, you'll be paying roughly $200 Sing for that. So to think that I can on the one hand sell a cow for $250, but on the other hand be selling 1.2 kilos of beef for $178, $200 a pop in Singapore, it tells me that there is some money in this business. You've just got to take some risk in those areas where there is margin and try and defend your margin and make it sustainable. But it's been a very interesting learning experience for us. Okay, I've only got 2 chapters. One chapter has to do with appetite, the second chapter has to do with solutions. So let's move to chapter 1, investor appetite. When I talk to Asian investors about Australian agribusiness, they actually love it. Most investors that I speak to, they live in very highly densely populated cities. They understand the constraints around agricultural land in their home countries, particularly Singapore, which has no agricultural land, noble agricultural land at all. They really do love the idea of owning land. They like it for more than just the emotional attachment, but they also like it because it's a real asset. And we've just been through 10 years of a lot of financial engineering, a lot of derivative oriented structures that have ultimately brought our financial system to near collapse as it did in 2008. So they like the fundamental nature of it. They like the fact that population's growing and that ultimately agricultural land should be a good bet, and it should be. They also appreciate that Australia is one of the world's leading traders, and our position in the world trade is very strong. If you look at all those commodities there, wheat, barley, beef, sheep, meat, sugar, cotton, wool, almonds, we are a reasonably strong trade partner for the world in those commodities, and they're important. If you look at our share of the trade, it's not insignificant. But if you look at our share of world production, we're relatively small, which means that if we had a dry year in Australia, we had a low production year, well, to what extent, how much impact do we have on world stocks? What is the impact of a change in production in Australia? What impact does that have on the rest of the world? Probably minimal, but it has a very large influence on the amount of product that is ultimately traded. So there are two aspects to that. We're not necessarily a huge producer, but we're a big trader, and that's what Asia appreciates about Australia. They also appreciate the fact that Australia is very closely located to Asia. They're the logical origin for procuring supply. There's a good reason for that. Not only is Australia a competitive producer of agricultural commodities, but because by virtue of our proximity and the freight cost advantage that we have in moving our products into Asia, there ought to be a premium attached to growing commodities in Australia that are typically priced out of the West. Whether it's sugar, whether it's beef, whether it's wheat, corn, soybeans, they're all priced out of the West, and it's our markets are always priced relative to Western markets, and because we're closer to Asia, there is what we call a Far East premium attached to Australian origin product, or there ought to be at least anyway. They also like the fact that we're a very professional industry. We have high quality producers. We produce high quality products, not only as a farming industry, but also as a food processing industry. I think our expertise, our know-how is highly respected, and hence the interest by many large Asian conglomerates and Australian food processing companies. And Goodman Fielder is a classic case in point. Another quote for you. I've done my best over a long period, but I cannot make it rain. This comment was made by Philip Forrest, the Managing Director and Chairman of NABCO, upon his resignation in 1936. And I put this quote here for a reason, because investors also struggle with the climate volatility that we have here in Australia, and it's always been there. But I was speaking to the chairman of one of Asia's largest agribusiness groups a year or two ago. He noticed my accent. He said, "Oh, you're Australian." And I said, "Oh, yes, you're right." He goes, "Yeah, overvalued assets, low yields, it doesn't rain." And so I spent the next 20 minutes, obviously defending my country and proving otherwise. But it is something that is, it's not a concern, it's there, and we have to be able to demonstrate how we can manage that year to year and show over a longer period. And I guess that's where the long-term asset approach comes in. You can't just look at 3 years like I've got here, where you've got 3 very different seasons. Over a 10-year period, you'll have maybe 3 or 4 good seasons, 3 average seasons, and a couple of not so good seasons. So that's really the way to couch this to investors, and so that long-term approach that Mick's been alluding to is that's the way you've got to play that argument. One of the more concerning issues for Asian investors is that they're immersed in growing economies. They're looking at food consumption growth curves upwards of between 6 and 10% in some commodities. And when they see that in Australia, with the exception of grain, which has grown very strongly, albeit with some volatility, most of our other agricultural commodities have kind of flatlined. And, you know, Asian investors like growth. That's the first thing. If there's growth there, yeah, I'm good there. I'm with you. But if you show them flat curves, it makes it very tough. So grain, yeah, there's interest there. I can demonstrate that. But for the other industries, how do I demonstrate to an Asian investor that we can turn that curve around and get it pointing northwards? They also talk about aging demographics of the farmer. Who's going to be the farmer in the future? I think farming expertise in this country is going to come at a premium in the future. There's no question about it. It has to. I've spent a lot of time in the palm oil industry, Indonesia, and you cannot imagine a better industry as an ageing executive to retire into or to retire out of. There are managers of very significant palm oil companies that are, you know, between 70 and 80 years of age that are still involved in the business because there just isn't anybody with the same know-how and knowledge and experience to run these businesses. That is a major problem. We're going to have to hold on to all the expertise that we have, particularly in the old heads, to carry us through for the next 20 or 30 years. Unless we can find a way of attracting more talent into our industry. And just while we're talking about that, yes, that is me and my daughter. We've got to convince the current generation that there's actually a future. To have a future, we've got to be able to demonstrate long-term sustainable returns. I think that's entirely possible. But we've also got competition. We've got competition from mining, and we've also got competition from our from generic industries. I remember, and Luke Chandler would remember this too. I went to uni with Luke, and there were about 30 graduates in our year. And out of the 30 graduates out of UNE Agricos, I think there was maybe 5 or 6 that are still in agriculture today or in agribusiness today. The rest of them went into other industries. So we do lose a lot of talent over time out of the industry. We've got to find a way of keeping them there, keeping them interested. For Tomo, it was good to be able to see him travel through China and right throughout Asia and learn about how other industries are structured, basically building his knowledge base to become, the man he is today. That, I think we've got to, if we're going to attract talent, we've got to show that we're an international business and we've got to take people offshore. You know, I speak to a lot of young people in Australia that want to be in agribusiness, and I say the first thing you should do, make sure that you're young, get on a one-way ticket to Asia. Don't worry about your salary, just immerse yourself in the industry. Go and run a sugar mill, or go and run a cashew nut facility, or just get out there, get your hands dirty, and work your way up. Because the sort of experiences you get doing that will be enormously beneficial when you come home. There's a richness of experiences in agribusiness if you are prepared to have a global perspective and be prepared to travel. It truly is an amazing industry to be in, and I never doubted it for 1 minute that I didn't study the right degree, and I think Luke would be the same. Okay, let's look at return on equity. This is where it gets a bit tough talking to Asian investors that are typically used to getting 15% return. What I've done here is I've taken, this is a return on equity chart excluding capital appreciation, so it's pretty much a cash return. I've taken the best possible return by sector on a national basis, and I know there's a lot of movement around these numbers, and you can dissect what is very much a generic curve and find high performers and low performers. But on average, from the numbers I look at, our cash return before capital appreciation is somewhere between 2 and 4%. Now, I've charted that against the average 10-year bond rate, and it looks like our cash returns are generally below what would be considered a risk-free rate. For an investor, that's a very difficult argument to justify. When you can go in and take Aussie currency risk at 4%, how can you show an at-risk return below that and justify it? That's the big challenge that I have when I talk to Asian investors. Now, the other piece of the equation is the land appreciation. And it is a very important part of the equation. It's the biggest asset in the balance sheet. And so what I've done is for those respective returns you saw on the previous slide, I've just added the capital appreciation that accrued to those that accrued to that cash return to come up with a total return across those years, the 20 years. It looks more respectable. We've got a total return above the risk-free rate. That story, yeah, I can sell that. I can sell that. But then we talk about, okay, well, tell me about the capital appreciation, John. What's it driven by? Is it driven by returns? And this is a chart that I'm sure you're all familiar with. I've plotted the average value per hectare, or capital value per hectare, for all industries in Australia, just as a generic curve. And there is quite a strong correlation between that curve and the level of borrowings, the growth in the level of borrowings over time. So there does seem to be a disconnect there, and land values seem to have risen less off the back of earnings and more off the back of access to debt. So investors, so does the glass half empty or half full. But we have seen the market start to play a role in normalising prices. We have seen prices fall in a number of sectors. And, honestly, that has brought some distress. But, the market is the market. But what investors are really looking for, they don't mind a low return necessarily, but they want to make sure that that low return or that moderate return relates or correlates to a level of risk exposure which is commensurate. So the returns must reflect the risk exposure, as I mentioned up there. So that's sort of where investors are sitting. They're really interested. They really want to invest, but they need the numbers to make sense in their context. And when you've got investors that have built their empires off, returns upwards of 15%, then we're saying, okay, we'll come down to Australia, there's lower sovereign risk, so I understand that, that's all good. But then asking them to accept a return that's sort of where the industry is today, and then, so there's a number of risks that you'll be exposed to which they are not familiar with, and it's really hard to get them over the line. So, there does need to be a change, an adjustment there. That adjustment can happen in a number of ways. I want to talk about 3 ways that adjustment could take place over the next few years. So let's rethinking the funding of agriculture. What do I mean by rethink? Let's really have a good look at the farmer's competitive position in the supply chain. Here I have represented 3 sectors. This is the back end of the industry, the back to the middle of the supply chain. We start with farm inputs. Then we've got the farmer, and then we've got the processor/trader. The farmer of which there are numerous. I think there are 135,000 farming businesses in Australia. The number of farm input companies globally is actually relatively small. And they're very large companies, and they wield a lot of influence. I remember talking to a very senior executive of a farm input company a couple of years ago. We sat down to lunch and he said to me, "John, what's my biggest dilemma?" And I said, "Well, I think your biggest dilemma is probably whether you charge at market limit or at cost price, or cost plus a margin." And he said, "Yeah," and that was just after the crisis, and fertiliser prices had gone through the roof and crashed. And I told him that if you price your commodity, if you price what you sell on a cost plus margin basis that delivered an acceptable return to you, you'd be able to deliver a more stable return to your shareholders rather than trying to jam your prices up to market limit. He said, "Yeah, that the way the market behaves, it's maximum profit, maximum gain. Everyone's trying to get as much as they possibly can." So that's farm inputs. Farm inputs is always placing pressure, pricing pressure on the farmer, regardless of whether prices are up or prices are down. Let's move to the other side, to the processor. We're seeing increasing consolidation and the immense power that these companies now have is also placing downward pressure on farm gate prices. So you can see that the farmers in the middle there, he's a price taker. There are many small farmers and they've got to make a living out of basically defending their margin against two very influential sides of the chain. Both sides, sitting on both sides of the farmer, are price influencers. You could even call them price makers, but I'll call them price influencers to be politically correct. Okay, let's look at what that means. If you look at what I've done here is I've indexed the gross value of farm production against farm costs from 1972 all the way to 2013. And what we can see here is that there is a high degree of correlation between our gross value of farm production and our farm costs. And when you consider the pressure that is on both sides of the farmer, it makes a lot of sense. It makes a lot of sense that regardless of whether markets are moving up or down, the relationship between revenue and cost is actually quite constant. And this is a very average curve, I understand that. But the forces that are causing this correlation relate to the previous slide. Okay? So what's the point in showing you that? The point of showing you that is that if we accept that there is a degree of correlation between our cost and our revenue, then the farmer's playing a margin. His game is to defend a margin. So what are the ideal conditions for defending that margin? Well, we've got to try and remove the volatility somehow. Okay? We've got market volatility, and we've had enough discussion on how to manage that. I think that's manageable. We've got to try and reduce exposure to the peaks and troughs in a nutshell. We've got seasonal volatility. We need affordable instruments to help protect equity from adverse seasonal changes, and that's another point I'm going to raise in a few minutes about how we can transform our industry and defend that margin and make our industry more sustainable. And the one that's really affected us over the last few years, or the last 10 years I would say, is asset volatility. There's been a lot of farms change hands in the last 10 years at values that didn't necessarily reflect the earnings potential of those properties. So ultimately, if we can adopt ownership structures that support the stability of asset values rather than promoting volatility in asset prices, then we're going to have a more sustainable industry in the long run. So, I'm talking to an investor about risk. What are the risks? Well, there's agricultural production risk, there's risk around the land and improvements, and there's also risk in the plant and equipment, just roughly speaking. Within those risk groupings, there's also, in agricultural production, you've got output price risk, which is your crop and what your production and how much you sell it for. There's input price risk. You've got to be able to manage that as well. And there's the production, operations and delivery risk as well. There are other risks, but these are the general ones. Land and improvements, well, you've got the soil quality, you've got pests, you've got diseases, condition of improvements, and your climate and seasonal volatility. Plant and equipment, it's the condition of the plant and equipment, how quickly can you write it off, labour, maintenance, fuel, those volatility and those costs, and obviously scale and utilisation of that equipment. Now, explaining that to an investor who's totally unfamiliar with agriculture, that's a really tough proposition. So, in other industries where there are complex risks, let's take mining for example, we've started to see the separation of assets, or the separation of risks, the segregation of risks. So, we can segregate agricultural production into three defined segregated risk buckets: agricultural production, land improvements, and equipment, plant equipment. So rather than having them in the one bucket, we can discreetly define those risks, find investors that are happy and have appetite for those risks and will come and invest, and you can link up those asset groupings through contractual arrangements. For example, the farmer can sell his land to a landlord, the landlord can lease it back to him or her. And the farmer could also be a contractor, but there also could be an independent contractor that basically plants the crop, maintains the crop, harvests the crop, does all the on-farm, all the on-farm operations for a fee. And this is the sort of model that we're seeing evolve in the West, Argentina and Brazil, in the US. You see a lot of this going on because there are discrete pockets of capital that have appetite for the risks that are inherent in each of those three buckets. So let's try and break down, what are the different attributes of these three risk buckets. Okay, we've got an income driver, it's all pretty straightforward. The income driver for the landlord is the lease, fee for service for the contractor, production margin for the farmer. When you look at capital requirements, very different from one end to the other. There's a higher capital requirement for land, and as you move towards the production, there's a lower capital requirement. In terms of risk grouping, lower leverage and volatility at the land end of the risk spectrum, and as you move towards the production margin, you're obviously getting more exposure to risk, but without being hindered by the equity requirement of the land, your ability to make a high return is more probable. And our expected returns, these are indicative, but these are the sorts of returns I think are needed to attract capital into each of those buckets. So 6 to 8 for land, 9 to 12 for a plant, for a contractor, and somewhere above 13 for a farmer that runs a farm operating business. So what can we do with the land? The land's the biggest asset in the balance sheet. Well, it could be sold into a real estate investment trust. A real estate investment trust is a sale and leaseback structure. They are prevalent throughout Asia. It's a well-worn investment structure, and it's also starting to evolve here in Australia, as it is in the US, and it's happening in many other industries as well. And if it's not a real estate investment trust structure, it'll be some other sale and leaseback structure. Okay? So this is a fact of life. This is happening in other industries. It's starting to happen in agriculture. And what this basically does is allows a farmer to farm more land without having the capital constraint of having to own that land. And if we've got fewer farmers in the industry, we're going to have to spread those farmers over more and more land. But that farmer can only afford to buy so much land. And this is one structure that actually helps facilitate that. Now, what if we're able to list that real estate trust and create a liquid interest in agricultural land? Wouldn't that be something? Wouldn't that be something? Can you imagine all those succession issues that we all faced with? How much easier it would be to deal with if we had an instrument that gave us a liquid interest in agricultural land. And if agriculture is to become a mainstream investment class, we need to be liquid. What are we talking about here? What we're talking about, in essence, is creating an agri bond. Providing exposure to agriculture to an investor, but without the volatility of the business exposure, the volatility in inputs and outputs. You leave that to the people with the expertise, the farmer, who's very good at that, combined with risk management expertise. It brings stability. Land should be a stable, defensive, reliable, solid asset. Long-term leases will give us stability because the value of the land will be related to the yield of the lease that the farmer pays. As I said, it's a well-worn investment structure. There's no rocket science in this. There are so many examples of real estate investment trusts all around the world. And liquidity, as I mentioned before. If we've got liquidity, wouldn't that be something? We'd be able to facilitate farm turnover to the next generation. That would be something quite special. Another message to the industry, and it's the last way of transforming agriculture in this country, and this is something I was very pleased to see Andrew talk about today. We need an agri-risk insurance product in this country. I think we all appreciate that we cannot have an affordable agri-risk insurance product without being plugged into global risk, and that's exactly what Andrew's created there. If you could insure the working capital of the farmer, as the top of my slide says here, we could unleash a lot of rural entrepreneurs out there. Just think about that. There's a lot of people, young people, I'm not so young anymore, but people that are younger than me that come to me and say, look, if I had the opportunity to farm, I'd love to do it. I'd really love to do it. And without the requirement of the capital to invest in some land and run his own land, a structure like this can help him farm a lot more land than he could ever hope to buy. And because we've got a contracting farmer base, that makes infinite sense. We've created a liquid interest in agricultural land, which all the mums and dads out there would love. And that young farmer that's taking the risk, the production risk, can protect his working capital. Now, wouldn't that be something? My concluding comments. And I've been a land fund investor. I bought midstream processing assets in India and China and plantations in Indonesia. You can change your opinions, and I've learned a lot over the years that I've been in Asia, and I've learned a lot from listening to people in this room and learning from people in this room. You can change your opinions, but keep to your principles. Change your leaves, keep intact your roots. Victor Hugo, from When Wool Was King, written by Alec Morrison. It's a quote that resonates for me, and I hope it resonates for you. Thank you very much.